the Harvard bombshell. Welcome back. Today we are doing a deep dive into the belly of the beast. We're talking about the suits, the establishment, the people who spent the last decade telling you that Bitcoin was a scam, a Ponzi scheme, rat poison squared, or just a pet rock. Well, I did some digging into the 13F filings. Those are the quarterly reports that big institutional managers have to file with the SEC, and the results are absolutely wild. If you've been wondering why the price action feels different lately, or why the media narrative has shifted from Bitcoin is dead to Bitcoin is an asset class, I found the answer. Here's the headline: Harvard is buying. That's right, the Harvard Management Company, the smartest, stuffiest, most risk-averse money in the room. They aren't just dabbling. They have made Blackrock's Bitcoin ETF, ticker symbol IBIT, one of their largest publicly traded positions. And they aren't alone. Today, we are going to look at exactly who is buying, how they are doing it, and why this is the ultimate example of game theory playing out in real time. Why IBIT? First, let's clear something up. When I say Harvard or Goldman Sachs or the state of Wisconsin is buying Bitcoin, I don't want you to picture a guy in a suit sitting in an ivory tower writing down a 24-word seed phrase on a piece of titanium. They aren't doing self-custody. They aren't holding private keys. They are buying IBIT. That is the iShares Bitcoin Trust from Blackrock. Now, why does this matter? Because IBIT has become a black hole for capital. It is arguably the most successful ETF launch in the history of financial markets. It reached $10 billion in assets faster than any ETF ever, faster than gold, faster than the NASDAQ trackers. So why are the big institutions using this instead of just buying Bitcoin on Coinbase? 2 words: career risk. If you are a fund manager at a pension fund and you buy actual Bitcoin and lose the private key, you get fired and maybe sued. But if you buy BlackRock's ETF, that fits into your existing compliance software. It looks just like a share of Apple or Microsoft on the balance sheet. It's safe for the corporate world. They are outsourcing the custody to BlackRock so they don't have to deal with the technical headache. But here is the kicker: BlackRock still has to go out and buy the actual Bitcoin to back those shares. So whether Harvard buys real Bitcoin or paper Bitcoin, the supply shock to the market is exactly the same. Who is actually buying? Let's go through the list. I pulled the receipts. Who is holding the bag? And I mean that in a good way. First up, the smart money. I already mentioned Harvard. They hold about $442 million worth of IBIT shares. This is bigger than their position in Microsoft. Let that sink in. The endowment that funds one of the world's most prestigious universities is betting on digital gold. But it's not just them. Emory University is in. The State of Wisconsin Investment Board, these are the people responsible for paying firemen and teachers their pensions. They are holding millions in Bitcoin ETFs. Why is this huge? Because pension funds are the slowest moving money on earth. Once they enter the chat, they don't day trade. They hold for decades. Next, the hedge funds. We're seeing the sharks enter the water. Millennium Management. They have over $60 billion in assets. They held nearly $1 billion across Bitcoin ETFs. Paul Tudor Jones, the legend. He's been bullish for a while, but his firm is expressing that trade through IBIT now. Schoenfeld Strategic Advisors. Another massive player. These guys aren't buying for belief. They are buying because they smell profit. They know the supply is capped, and they know the demand is infinite. And finally, the hypocrites. The banks. This is my favorite part. The big banks. The too big to fail crowd. Goldman Sachs. In 2020, they said Bitcoin isn't an asset class. Today, they hold over $400 million in Bitcoin ETFs. Morgan Stanley. They were the first major wirehouse to authorize their 15,000 advisors to pitch Bitcoin to clients. JP Morgan. This is the best one. Jamie Dimon, the CEO, is famous for saying he'd fire any trader who bought Bitcoin. He called it a pet rock. Well, guess what? JP Morgan is an authorized participant for the ETFs and holds shares on its books. Watch what they do, not what they say. This brings me to the concept of game theory. In game theory, there is a point called the Nash equilibrium. It's the state where no player can benefit by changing strategies while the other players keep theirs unchanged. For a long time, the equilibrium for Wall Street was ignore Bitcoin, it's risky, it's for criminals. But BlackRock broke the equilibrium. Larry Fink, the CEO of BlackRock, flipped. He went from a skeptic to calling Bitcoin flight to safety. Once the biggest player moves, everyone has to move. If you are an asset manager and Bitcoin goes up 100% in a year and you have zero exposure, you underperform your benchmark. You lose clients, you lose your bonus. FOMO isn't just for retail investors buying meme coins. FOMO is for institutions too. The perfect example of this is Vanguard. Vanguard is the second biggest asset manager in the world. Their former CEO, Tim Buckley, was staunchly anti-crypto. When the ETFs launched in January 2024, Vanguard blocked their customers from buying them. They said, "We will not facilitate this." What happened? Customers revolted. They moved billions of dollars out of Vanguard accounts. So what did Vanguard do? Tim Buckley retired. And who did they hire to replace him? Salim Ramji. Do you know who Salim Ramji is? He is the former Blackrock executive who literally oversaw the launch of the IBIT ETF. You cannot make this up. Vanguard fired the anti-crypto guy and hired the guy who built the Bitcoin ETF product for their competitor. That is the power of the market. You can't fight the tide. And now, even Bank of America and Merrill Lynch are recommending a 1% to 4% allocation into crypto. The dam has broken. Paper versus rock. Why you win. So what does this mean for you? If Harvard and Goldman are buying paper Bitcoin, ETFs, and you are holding real Bitcoin on a hardware wallet, are you at a disadvantage? Absolutely not. You are actually in the superior position. See, when Harvard buys IBIT, Blackrock takes that money and buys Bitcoin from the market to back the shares. They lock it up in a Coinbase vault. That Bitcoin is effectively taken off the market. It reduces the supply. But Harvard doesn't own the Bitcoin. They own a claim on Blackrock. They have counterparty risk. If the government decides to seize the ETFs or if regulations change, Harvard is stuck in the system. You, holding your own keys, own the underlying asset. You own the thing that Harvard is desperately trying to get exposure to, but you own it without the middleman. You front-ran Wall Street. You front-ran the Ivy League. And now they are bidding up the price of your asset. Every time a pension fund in Wisconsin allocates 1% to IBIT, the value of the Bitcoin in your cold storage goes up. They are providing the exit liquidity for the early adopters, but more importantly, they are providing the floor. Bitcoin is becoming too big for them to ignore and too integrated for them to ban. So here's the takeaway. The smart money is finally here, but they arrived late and they arrived using a wrapper that gives them price exposure, but zero freedom. They are playing the financial game. We are playing the sovereignty game. If you have been waiting for a sign that Bitcoin is legit, this is it. Harvard isn't buying Dogecoin. The state of Wisconsin isn't buying NFTs. They are buying the scarcity of Bitcoin. The game theory is forcing everyone into the lifeboat. First the tech nerds, then the libertarians, now the hedge funds, next the sovereigns. Don't let them shake you out. Watch the flows into IBIT. Watch the 13F filings. The revolution is being televised, and it's being filed quarterly with the SEC. Thanks for listening. If you haven't moved your coins off the exchange yet, maybe do that today. Don't be like Harvard. Be your own bank. I'll see you in the next episode.